Welcome to World Ledger with Coco Key, your gateway to global perspectives on Bitcoin, blockchain, crypto digital assets, and AI. Everything here is for informational purposes only, not investment or financial advice.
It was almost exactly 1 year ago, February 19, 2025, when I had you on this show. And at that time, I remember Bitcoin was sitting at 96,600, gold was at 2934, S&P was at 6144, and Shanghai Composite was at 3320. Fast forward 1 year later, a lot has changed. Everything marched higher. Bitcoin is the odd one out, losing about 15,000. And now on top of that, we are in the middle of a war with Iran, and markets are trying to make sense. What comes next? It's a perfect moment to bring you back. Let's review what 2025 actually gave us in a macro picture, and then I want your predictions for 2026. Following that, I'll ask you some follow-up questions. Welcome back to the show, Shengbei.
Thank you so much. I'm glad to be joining you again after about 1 year. And it has, of course, been a very interesting year. I'm glad to be able to share some of the review what happened last year, plus a bunch of projections I made for 2026. And of course, during the question and answer, we're going to incorporate some of the events that occurred in the last month and a half. But since we talked February of last year, I would use that as a starting point from mid-February to early April. Sell dollar and sell US risky asset is the right trade to do. At the same time, long gold. This is my anticipation of a global reset. Nobody knows exactly how all the countries would respond to tariff situation. Many people probably did not even realize that could happen. In my view, it's inevitable. Sell dollars, sell US equity was the right trade. And of course, gold, as we discussed before, is more like a new anchor for the international settlement system, would be bid up. That is part of the trade I was talking about. April 2nd, when President Trump announced the Liberation Day tariff, I was on calls with quite a lot of people. Many people seek my views. I said to them that I think all the previous ultra bearish view will come to an end. The reason is now tariff is clear. That means US will be in the driver's seat for the foreseeable future. Tariff would probably deliver positive news to the US. When you look at tariff, there are two elements that go hand in hand. Tariff is one, the other one is domestic tax policies. The domestic tax policy, basically the big beautiful bill, when that happens, that element will also deliver positive result. Given the low oil prices and relatively cool housing market, it's hard for the inflation to pick up. Therefore, I think there could be a unique period of time. We are going to have a US-centric economic growth. I basically switched to a second gear, ultra long US equities and ultra long crypto. Fast forward roughly around August, I changed my view again. Basically, we are still in a continuation of the post-August 2025 macro environment. Why I changed my viewpoint again? There are three reasons I was very bullish for the US equities and crypto. One of them is tariff. By August, we knew tariff already mostly negotiated. The outcome was not ideal. It's not as we hope for the US, because if you put equal tariff on all countries, China would do better than all countries in handling that pressure. Some of the European countries are not so fortunate in terms of the tariff outcome. Tariff was kind of hurting some of the US allies. The Big Beautiful Bill was signed into law in early July. But Big Beautiful Bill couldn't handle the deficit problem. In fact, it could make it worse. Even if there are certain elements that help the working class, like the no tax on tips, it still doesn't go far enough, in my view. This K-shaped economy that we have been experiencing for a long time will not get any better after the Big Beautiful Bill. Tariff may introduce certain degree of slowdown in economy, certain inflation. They didn't happen until August. Around that time, We know the job numbers are not as good. I knew a lot of that had to do with immigration issue, the supply demand of the labor market. From that time going forward, I switched back to long gold again. Instead of being focused on US-centric equity market, I would say we're now in the global diversification stage. That means you should invest in pretty much everything. There's no clear winner. The clear winner should have a certain degree of integration. Japan had this interesting framework with the United States. Some of the policies, the tariff decisions Japan made in connection with the United States was like there's a certain degree of integration. So now we have a combined financial system and a monetary system between two large, powerful countries. That actually helped both. Japan benefit from that. Also because of their decision to invest in the US, I'm sure that helped US economy, US market, but far more so to their economy, their stock market. That's a stage we entered since August. The liquidity condition, roughly starting September, October-ish, was no longer as good as before. That's kind of how I characterize the 3 stages of macro condition, and how in the 3rd stage, started in August, the liquidity started to worsen.
It's very interesting that you divided 2025 into 3 distinct periods, especially based on the tariff decision and other policies in the US. What I'm interested in learning is, am I hearing you correctly, that in the beginning you were bullish about US economy, especially after April, but after that, you changed your stance and you decided that there would be no clear winner. You have to bet on all the markets versus focusing on the US market. Is it because you are less bullish because of all the policies that you don't think will work out that great?
I would say there has been a certain degree of diversification away from the United States even before 2025. Among many international investors, the gold is perpetually bid up. Then we get tariff. As you sort of anticipate tariff, all countries are going to become somewhat protectionist, causing global traders to diversify away from US dollar-based asset. We are still at a transition stage for this ultimate goal. In fact, the US trade deficit is going down marginally. A lot of things we expect to happen have not really happened yet. So in that case, it's almost inevitable that the process to diversify away from US equity market or risky asset will continue to play out. So that is why the US dominance in the financial market after August 2025 was not so clear-cut. Even though US equity market hit new highs many months in a row, that speed of increase was low. You compare that to many other markets, you can see the effect. I think, unfortunately, that may continue for quite a long time.
The data shows that US was lagging behind quite some markets, including Latin America, Europe, even Asia in 2025. So how about 2026? What is your thought? Will it be a continuation of the last quarter of 25? What kind of factors or drivers you are waiting for to change this market to a different direction, especially for equity market for risk asset?
This year will be the midterm election year. We also are going through transition of the Federal Reserve leadership. There are quite a few factors that can move the market. In the beginning of 2026, we already have a few warning signs. The first issue is liquidity. There are symptoms of liquidity problem happening in October. The Fed stopped the QT process, then immediately switch to balance sheet increase, even though they don't call that QE. It's a reflection of liquidity concern in the system. So that is number one issue with liquidity. Last year, when I was talking about, I was long-term bearish on Chinese economic growth. I mentioned Klasky-Levy profit equation, how I projected in 2021, China will go through a very slow growth for at least a decade, maybe longer. Klasky-Levi equation can be applied to AI-driven economic growth model. The bottom line is this: if you invest, whether it's through public or private hand, that investment will turn into profit of some corporations. However, the downside is it's only guaranteeing aggregate there will be profit, but the reflux of the capital go from company A to company B and to consumers and back into other investment with financial asset. All that loop is not clear cut. We have a massive buildup of the AI infrastructure. Not everybody benefited from that. I think AI investment may even trigger certain credit issue. Such a large investment only guarantees profitability in aggregate level, but it does not guarantee individual player. Lack of cash flow or lack of profitability by itself can create a credit problem. I expect certain issue to pop up for AI-driven economic model that will take time to resolve. That is AI-driven issue. The third thing I would say, Supreme Court may deem tariff illegal. I hope they didn't strike down the tariff because I view this tariff and tax reduction on the big beautiful bill, the coordinated movement. If you weaken one, the other policy is highly questionable. That's why I anticipate the inflation issue and the credit issue down the road. That's why this year I'm relatively risk averse.
Let me ask you some specific questions to unpack so many things that you just talk about. For 2026, how about the gold rally? Will the gold rally continue? Will the precious metals and industrial metals rally continue?
Around August, I switched back super bullish on the gold. I think will continue for a very long time. You may experience volatility, but that's natural for the market. I'm talking from macro point of view. This is a point we raised about a year ago. Think about Bretton Woods system. Initially, gold has this convertibility to dollar. And when you have a system, it's a semi-gold based monetary system, is very bad for the domestic economy due to the natural deflationary effect of the market. However, after Nixon abandoned the peg between dollar and gold, we are on the dollar system. Many years after that, the central bank was selling gold. But that changed due to abundance of liquidity and QE. And we talked last time that China, in order to float the RMB, whoever trade with Chinese merchants have certain convertibility through gold. That means now you are giving gold medium of exchange effect. That already started many years ago. Global trade still anchored in the US dollar, but there is a supplementary role played by gold. Now, gold is becoming more important gradually over time. Therefore, that trade, gold as monetary metal, can go on for a very long time. Could be a decade-long trade. The gold rally will continue. That's my long-term view on gold.
I want to follow up on that part. People speculate, which has not been validated, that some countries trade with China and accept the Chinese currency. China and those trade partners, they bypass dollar trade with RMB. But of course, those trade partners don't want to sit on RMB, which is not globally liquid and exchangeable. So those trade partners would convert RMB, the offshore RMB, into gold. That is the trade happening a lot in some part of the world. I wanted to get your thoughts.
I think it's very hard to get data to prove how much that is happening. However, that is conceptually true, that's happening. But I would say it doesn't matter, like how much of that really happens. What matters is that can happen. That actually is not just for China because of tariff. We are going through a global restructuring. of trading system, gold was used as a global settlement. When you go back to this new approach, this can automatically elevate gold. That's why I think this trade can go on for a long time.
A lot of the trade with the Middle East, the oil countries use RMB. With gold's help, China could grow its currency globally. I think that is happening.
I agree with you. I think that's happening. When people say Chinese RMB should increase in value, they often think in the term of export-import. China's currency is getting accepted by many more countries. That is causing a new realignment of the global system.
That would be a challenge to dollar's dominance in the world. At least for the settlement part, RMB could play a bigger role. On the same topic, China's central bank has been reducing its holdings of U.S. Treasuries and stocking up gold for a while, maybe 5-6 years. That, I believe, is a process of de-dollarization. Do you think that trend will continue and will become another factor to drive up gold's price?
Not only China, many countries' U.S. Treasury holding peaked about 10 years ago, no longer grow as much. China's holding has declined. Also, central banks globally are buying gold. In terms of how China's Treasury holding impact the U.S.-China financial setup, there's an even bigger issue. China is becoming a debtor country to many global trading partners. China's large holding of dollar helped China to be in that position. It stopped recycling surplus in the U.S. Treasury market and found the U.S. deficit. China has a different outlet now for that money. So it caused a certain negative impact on the U.S. financial system. U.S. is engaging in many policies proactively to solve that issue.
Let's talk about dollar after we talk about RMB. The dollar index has been in clear downward channel. And the question I keep coming back to is this just where markets are taking it, or is this by design? I mean, the administration is engineering a weaker dollar. And if the trend does continue, what does that actually mean for the rest of us? Who will win, who will lose?
The administration clearly have implied, even stated multiple times, that they prefer some dollar weakening. Going back to what I talked about last year, I was very bearish on dollar before April and May last year. But then after that, I gave up that trade. The reason for that, sometimes there's a sudden surge of dollar. Even now, there's a sudden surge of dollar a couple of days ago after Persian Gulf the issue surfaced. That can also be a liquidity problem because sometimes the liquidity problem can drive up the dollar. Dollar is a little bit tricky. I would say long-term, U.S. probably prefer a weaker dollar because at the end of the day, dollar weakness can help bring more manufacturing back. There is a concern starting 2-3 years ago, the U.S. is entering the stage of fiscal dominance. When you enter fiscal dominance, monetary policies serve fiscal policies. That also causes a long-term sustainability issue for the domestic monetary system. When that's the case, there is a degree of doubt about dollar can maintain that status. That issue is not just for U.S., it's actually for all the countries. We have to monitor all of this, see which of them lose their control faster. U.S. clearly have a huge debt issue, which also weakens dollar.
Look at the spending in the U.S. When a new administration took office, one of its core promises was to cut budget deficit, to exercise fiscal discipline. But a year in, I'm not seeing much real progress on this front. I totally understand the debasement trade is becoming more dominant. And if that's the case and dollar is weakening, which is kind of inevitable in the long run, then does that create the runway for hard assets to keep rallying in 2026? For example, real estate, metals, even Bitcoin.
I would say the clear winner is gold. Industrial metals would also benefit from this trend. At this stage, we are having a little liquidity issue in the financial system. On the economic front, there's more money going to industrial build-up, going to like AI build-up. Those, at the end of the day, have real effect on real economy. So from the real economy, liquidity is still relatively strong, supporting industrial metals and their rally. After the period of U.S. dominance from April to August, you basically go into a new stage characterized by gold outperform Bitcoin and the US dollar and other markets outperform US equity markets. The industrial metal surge again. The bond didn't go anywhere despite 3 more cuts. The long end, in fact, moved up. About crypto, I would say I was extremely bullish on crypto from April to August. After that, I started to have real concern. The reason is liquidity concerns start to show up in September. Liquidity is going to show up on the ones that rely more on concept. Those stocks will go up. To some degree, crypto have that effect. From statistics point of view, it's pretty clear crypto has been going as extended version of NASDAQ for years, even though sometimes they deviate a little bit. In long run, they tend to go up and down together.
When we talked last year, you had a different thought about MicroStrategy and Bitcoin. And since then, what has changed? What remains the same about your stance on MicroStrategy and Bitcoin?
My viewpoint changed according to 3 macro regimes. I talked about I was bearish on US equity and bearish on crypto and MicroStrategy. Of course, I switched to extremely bullish for a few months. But then we're talking about September liquidity is a big concern. And there's a global monetary system. People diversify away from US equity markets, bullish for gold, but also bullish for US dollar linked asset. Crypto is one of them, very much US dollar based asset. I switched off this trade completely because liquidity is going to hurt the ones that rely more on concept as opposed to rely on earning. The high earning stock will still survive, still do well. The global monetary reset, money moving away to other markets, crypto, at the end of the day, is kind of US dollar asset. So it's kind of benefit gold instead of crypto. That coupled with the rotation caused by liquidity problem is going to punish crypto further. And thirdly, I had a full analysis about how strategy claimed to offer perpetual preferred stock as opposed to a convertible bond. I think the best thing they offered that really benefit their fundraising capabilities is convertible bond offered between early and late 2024. I spent a lot of time looking at how this convertible bond help strategy elevate their stock so much. During that time, MNAV is more than 2. Now it's below 1. And look at all that combination, liquidity, the global monetary system redesign, money moving away to other markets, and the unique role played by not only MicroStrategy, but a bunch of other people trying to copy that approach, that created a structural issue. All 3 elements were negative. That's why I switched to very bearish on the sector. Today, there seems to be a big rally of certain assets, but still, we need to see this to be sustained. I do believe long run, they are part of asset that will do very well in a global debasement trade, but that need to be proven by data, by their detachment from traditional asset, but that has not been proven yet.
One of the theories or explanations about Bitcoin since last quarter is because Bitcoin has this 4-year cycle. As soon as you hit a certain time frame, then OG start selling. And that is one theory. We don't need to get deeper into that. I want to go back to the liquidity point, you kept bringing up liquidity has been tight since last quarter. And what is the exact reason? And is there anything that either Fed or government can do to improve the liquidity situation in the U.S.?
Basically, since the COVID, liquidity has been more than abundant. The Fed balance sheet went up huge amount. But after QT started, we started to draw that down. The initial drawing down balance sheet didn't impact market that much because there is a pool of money called reverse repo. All that surplus liquidity stored in the system go down at a very fast pace. In 2024, there was liquidity issues. Fed started to slow down the QT. They cut interest rate 4 times in 2024 and 3 more times in 2025. All that is a way to make sure liquidity situations do not get bad quickly. But by the fourth quarter of 2025, we'll use up all the reverse repo. In fact, even before that, we'll use it all up. That's number one. And two is, as financial markets go up, they naturally need more liquidity. Otherwise, things will slow down because the natural demand for increased liquidity, the reduction through QT, and the draining of reverse repo program need a very unique structure for the money to float back to the system. We got helped by the tariff negotiation. Certain countries, especially Japan and Korea, already promised to invest in the U.S. And on one hand, they have large trade surplus with the U.S. At the same time, they have a depreciation of their currency against dollar. They build up their balance sheet domestically. There's a huge pool of money going to invest in the United States. That, in fact, increases liquidity for the U.S. We benefit from that already. Another benefit we temporarily receive is China's large surplus, right? The fourth quarter of 2025, Chinese-owned U.S. dollar asset has surpassed that of Japan. Instead of the official reserve holding, a lot of money comes through private institutional investors. They invest in equity markets. That also temporarily improves the liquidity. My argument is liquidity, in fact, is worse than what appears. Unfortunately, Federal Reserve, Phillips Curve, and Taylor rule do not deal with liquidity issue directly. If liquidity causes the bond market to malfunction, they will immediately jump in to increase liquidity. We are at the stage where there's a slow decline of liquidity. I think there is no easy way to deal with this. This issue will go on at least until the new Fed chairman comes in and design some new policies.
Perfect transition to talking about our new Fed candidate and new Fed policies. When Trump announced Kevin Warsh as his pick for the next Fed chair, markets sold off hard, really hard. The conventional explanation is that he is a hawk. He has been advocating for shrinking Fed's balance sheet, tighter policy, and less accommodation, etc. So what do you think is really behind that sell-off and why the market reacted in such a way?
Talking about shrinking the balance sheet for the Federal Reserve is going to create a very bad impact on the market. The market started to sell. I also think liquidity is already an issue. Between the Fed January meeting until the new chairman shows up in May, there are 2 more meetings. Probably people anticipate there's a very low chance of any market movement. Any support of the market in this transition time. Essentially, the stage of vacuum for monetary policy changes. So that alone can make whatever problem that may occur in the next few months far worse. That could be the reason too. It's hard for me to imagine Kevin Warsh will actually shrink the balance sheet unless he does it in a clever way. Before 2008, U.S. Treasury's holding is not in the Fed balance sheet. TGA, the Treasury General Account, was very tiny. It tried to reduce the footprint in the financial system. The Treasury held very little money. at Federal Reserve, their holding held in commercial banks. It's called TTL, the Treasury Tax and Loan Program. Now they have huge footprint in the financial system. Let's play devil's advocate on this one. Imagine tomorrow, another aspect I like a lot, Warsh and Bessent can work as a team. I think it's a positive thing in the long run because there is a need for some reform in how the Reserve and the Treasury Department work together. Imagine tomorrow, Federal Reserve is allowed to work with the Treasury Department to move $800 to $900 billion into commercial bank. What happened to Federal Reserve balance sheet? Actually, no impact. I'm talking about hypothetically, move everything in one day. The reason it cannot move is because the asset side of the Federal Reserve is fixed. TGA is part of the liability side. Clearly, it cannot move. What happens if TGA drops to nearly zero? At the same time, increase the reserve. That means all the commercial banks are going to deposit money at Federal Reserve through the form of reserve. So that move alone is going to inject huge amount of liquidity in the system. So we're talking about a situation where balance sheet does not move at all. That, of course, is purely hypothetical, but that means conceptually, you can have a way to redesign the system and you can actually shrink the balance sheet, but in fact, you can do so causing liquidity to increase it. So I think that is what we need to think about, not just the traditional way. I think what enter a stage I call the macro competitive environment where all rules will be subject to change. That is one of them. So I do like the prospect of two of them working together to deal with many of the longer lasting structural issues we face as a country.
Personally, you like this pick.
I like Warsh's pick. I even like Bessent's pick better. I think Bessent the best pick. I think that's almost God said.
That brings me to my next question and last one. There are 8 FOMC meetings in 2026, and prediction markets are saying rates will stay unchanged between now and May when the new Fed chair takes office. But at the same time, I've been hearing from a growing number of observers who are very concerned, saying that job market has been quietly deteriorating. So who is right? And do you think that it's the time to cut? It should be cutting?
The interest rate impact on inflation and on the job market is very slow. If you just go with traditional Phillips curve argument, I think no cut makes sense. However, having said that, I think we need cut. The reason for that is the financial market, because now the U.S. economy are so much driven by financial market. Imagine there's a stock market decline, all of a sudden, the wealth effect is going to be felt in the consumption in some future time. When that happens, it's very bad. Liquidity issue is now impacting financial market far more than the real economy. My concern is more about financial market as opposed to real economy, but that's not a Fed mandate. Therefore, from their point of view, they can no cut.
The market will probably stay very jittery between now and May because it's a vacuum, as you just said. There's a big vacuum of policy from the Fed. We stay cautious between now and then. What a wonderful conversation. Your insights are always practical, and also very good. Since market changes so much, love to bring you back anytime in the near future, not wait for another year. Thank you for listening. Your support means the world to me. Share this episode with friends and family, and don't miss out on my newsletter, worldledger.substack.com, for the latest updates. See you next time. Bye-bye.